Well, that should.
Huh? Sorry about that, guys. What's up, Abe Nation? Boss Blunts, Marcel Flitovic here. All that, nobody could hear me. Great. I appreciate you guys letting me know. Thanks, Rancher. Rancher, my guy. Appreciate you. Where's he at over here? I seen him. That's my man right there. Thank you, Rancher, from the last stream. Appreciate the shit out of you. You guys are awesome. Mike JP from the last stream. Thank you very much. Starring Eli, everybody else. Anomaly. Thank you guys so much. You are not required to donate. Please don't donate unless you got money to burn. 50% of all the proceeds will go to the channel and technology. 25% will go to charity this month. That's going to be a charity that benefits United States veterans. And 25% goes to my kids' AMC and GameStop college fund. Yeah, appreciate you guys. Thanks. And that's our subscriber number right there. I'm not sure if you can see it. It's probably pretty small, like 4,000 or so. Thank you guys for subscribing. Appreciate you. If you have the bell checked for the notifications, make sure that the bell is changed to all instead of just personalized, because there's three options. There's none, personalized, and all. If you click all, it should technically give you guys the notification when I come on, or when anybody goes online. If you click that bell and click all. Yeah, thank you guys. Like I said, please don't donate unless you got money to burn, okay? Because I don't want anybody's money. I just realized that certain things, like, you know, the technology required for this and other things like Ortex, and I'm hoping to get a Bloomberg terminal for everybody if possible. All that shit costs money, you know? So I figured, okay, I'll do that, and then I'll give a good portion of it. I'll give 25% to charity, and the other 25% to my kids' college fund. That way, I am directly benefiting from it. My kids are, you know, going to get 25% of the proceeds after taxes. But I would much rather give it to them than keep it for myself. And it's all going in AMC and GameStop until it moons anyway. What's up, Aaron? Thank you. Pico, the chain. No, please don't drop funds. I don't want you to drop funds. If you do, thank you very much, but I don't want you to. There goes Rancher. This freaking guy, man. Thank you very much for your support, brother. Cockroach Rancher says, I ain't burning money here. Puff, puff, pass the MOASS. That's what I'm talking about. Got to keep that positivity going all the time. Let me turn on this friggin' music. Sorry, was that friggin' audio annoying? All right, thank you, Pico. Appreciate you. That was way too loud. I didn't realize that. Greg, Hate Time, Elka, Papillion. Thank you, boys and girls, for coming out. It's good to see you. Woo-wee! Look at this, guys. Holy shit. Cockroach Rancher, thank you very much for the donation. Appreciate you, brother. You are the man. You have been too kind, my friend. Too kind. Please stop donating, Cockroach Rancher. I appreciate you, brother. How'd you know? It's Bonobo El Toro. That's exactly right, the show pill. What's up, Needless Swap? We're going to be covering a few things. Federal Reserve, S&P, Case-Shiller U.S. Home Price Index. We're going to be covering the S&P 500 Shiller PE ratio, which is adjusted for inflation, which literally is showing that our economy is our stock market is extremely oversold, which has only been surpassed once in history. We're also going to be looking at the federal H8 report released on Friday, September 10th, with the newest, highest numbers for bank assets and liabilities, especially liabilities, that we've ever seen. And we're going to take a look at a couple other things over here that I will save for later. Just reports all the way through. I'm going to try to make this no more than a 1-hour video, but I've said that before and they turn into marathon sessions. So I apologize. Maybe I'll put chapters in here if I can. Rancher says, Boss Blunts, people buy bugs I grow. I got XXX GME today. I am happy to share some. Always have been when I can. God bless you, brother, and I'm happy to hear that. Now I see why your name is Cockroach Rancher. That is the most fucking clever thing I have ever heard in my life, brother. You can make money off of bugs. That's the American way. You can make money off of anything that you can think of selling. As long as there's a demand for it, you can become infinitely wealthy from it if you play your cards right, work hard, hustle, and always continue learning. That's it. Merlin, Greg Peters, Blue Hefner, good to see you guys. Please hit that like button. If you feel like subscribing, please do. Irish, thanks for coming out, brother. Excuse me 1 second, guys. We'll get started real quick here. Excuse me. Sorry about that. I should have muted my mic. Thanks for asking. It's not a Royal Oak. It's a Belova. It was it was like a milestone for me. I bought this watch. I got it as a gift, kinda, and I also pitched in on it because it was so damn expensive. But I bought this watch basically when one of my companies hit the $500,000 a year in revenue mark, and that was early on. And I haven't bought a new watch since, because I wear this one every single day, because even though my companies are much more profitable and worth much more now than they were at that time, this was not cheap, and it was also kind of, it's a humbling reminder of how hard you have to work to be able to afford anything. And it kind of helps me keep my feet on the ground to look at it every day and remember the reason that I bought it. What's up, Dixie? Why bother? And yes, it's good to see you. Circle the Baggins, Mr. Baggins. Mr. Baggins. Aaron, thank you very much, buddy. Aaron says your content is outstanding. I love the enthusiasm, the pot smoking, and that you have all sources for all your data. Thanks, brother. I would have it no other way. I'm not going to front for anybody. I'm not here to put on a presentation. I'm not here to try to gain clout and to try to, do anything other than provide information. And I'm having fun while I'm doing it. I'm going to drink. I'm going to smoke, whatever. Right today I'm drinking LaCroix, but some days I'll drink beers. And that's just my thing, So if I'm going to be spending hours and hours researching this stuff, I'm going to do the same thing with you guys that I do when I'm by myself sitting here looking at all these fucking charts. And the reason that I started looking at these is because this is what you need to start looking into if you want to invest in real estate, if you want to invest in business, if you want to have any sort of real future, because you can't just go off of what you think. You have to go and look up sources for things that are publicly available, given to you by the government, and these regulatory bodies will give you all the information that you need to fucking know if you just bother taking the time to look for it. Jerome B says, y'all were dropping gems in the Bull House today. Ready to soak up some more. Thank you, man. I love Kenna and the Bull House. Those cats are fantastic. Follow their podcast. They got a YouTube channel, brand new YouTube channel, The Bull House. Check it out. Fantastic content. She posts all about the stock market and real estate and all sorts of other things, usually twice a day. You guys are going to love that content too, just so you know. David, Jerome, thank you guys. Greg. Aaron, thank you again for your donation, buddy. We appreciate your support. Again, let's see what we got. Oh my God. You guys see this? That's from the White House. September 9th, 2021 article. Nobody has talked about this. Nobody knows this shit exists. Nobody. But look, it's posted on their website, whitehouse.gov/CEA/blog 2021-99 Housing Prices and Inflation by Jared Bernstein, Ernie Tedeschi, and Sarah Robinson. These people work for the fucking White House. What are they telling us about the cost price index? That's inflation for shelter. The CPI for shelter is at all-time highs. And this green bar is the Case-Shiller. That's also at all-time highs. You guys know what happens when the Case-Shiller gets too fucking high? The Shiller, probably not. I'll show you. It's a very smart individual. Hold on one second. This guy right here from Money Week is a very smart individual, and I'm going to let him explain this to you because he does a perfect job of it, and I would rather somebody who is more eloquent with finance speak. His name is Ed Bauscher, and this is from Money Week videos on YouTube. Now, this video is from 2018. It is prior to the 2018 market crash, and wow, you guys are not going to believe how on fucking point he is. We get to the right portion of the video. This is the one thing I didn't have pulled up just because I didn't think to show this to you guys until just now. But I'll fast forward to the part where that actually matters, because the equation for the Shiller PE shouldn't really matter to you. Just know that it takes into account for inflation, and not many things do. And I'll explain that really quickly. The S&P 500 price to earnings ratio is calculated by dividing a company's stock price by its earnings per share. But what the difference between that and the Shiller PE is, the Shiller PE does that same thing, but it takes into account for inflation. That's what makes it a beautiful thing, an amazing indicator that's used for majority of market indices like the SPY and the S&P and shit like that. Trying to close this ad. John Curtis, thank you so much, man. Please, oh man, you didn't have to thank me for asking, for talking about stock delisting yesterday on AMC Bigham's Discord live YouTube stream. I'm more than happy to do it, buddy. And the reason being because we want to spread that knowledge. So Jackson Hunter and I, as well as AMC Bigham's and XX Wired, all YouTubers, all Redditors, all Twitter guys that are really deep into these stock marketplace, have been doing a lot of due diligence together and doing hours-long videos, and we're going to try to do it every Sunday and see if we can do that as well, every Sunday night. So thank you for supporting the channel, John. Please don't donate again, brother. Ask me anything you want. Let's see here. I know. That's what it's all about, education. That's why you ask me, I ask them. All right, here's what we got, guys. The S&P Shiller ratio. The Shiller PE is a more reasonable market valuation indicator than the PE ratio because it eliminates fluctuation of the ratio caused by the variations of profit margins during business cycles, ups and downs. So it kind of flattens everything out and really helps them.
P index, which is the biggest, most important index.
Here you go. I'm gonna let you guys listen to this. Listen to this guy.
The S&P index, which is the biggest, most important index in the US. So right now, if you look at the S&P, its current ordinary P ratio is 16. So that says to me, well, the US looks sort of not too cheap.
What's up, Leo? Christopher Casey, thank you. Watch this. He's saying back in 2018, the current PE ratio was 16 for the S&P 500. All right, 16. Sorry. The PE ratio, the standard PE ratio was 16. The Shiller PE ratio was 25 because it accounts for inflation.
Let's see, how things have gone in other periods of history. I mean, the historical average.
Got you. Thanks for letting me know. I got this. 1 second, guys. Adjusting these volume levels.
Is 16 for the Shiller PE. But probably its highest number ever was in March 2000 when the Shiller PE was 43.8.
What are you saying right here? Look at his goofy face. The current PE in 2018 was 16 at the time of in July of 2018. And then the actual Shiller PE, not the regular PE, was 25. The highest it's ever been in history was 43.8.
That was just before the whole dot-com crash. And actually, Robert Shiller at that moment published a book called Irrational Exuberance, and he said the stock market was way overvalued. And my goodness, he was right. Back then, I was a young, naive investor, and I didn't believe him, but the numbers were telling the story. America was way overvalued. I wish I'd sold all my shares at that stage. And let's look at another interesting moment in history, early 2009, when we were in the whole middle of the whole credit crunch financial crash.
Oh, wait.
The conventional PE ratio at that time was around 47. So that was saying the market was really expensive. But that seems counterintuitive because share prices were crashing. How could the PE ratio be high when share prices were crashing? Well, the reason was because earnings here was falling even faster than the share price. So seemingly the American market was expensive. It wasn't. If you look at the Shiller PE for 2009, it was more like 13, a real buy signal. The market's
saying
cheap.
2009,
it was
right
time
after
to
the
buy.
market crash.
And thankfully, I did buy a few shares at that point. So as I say, it's most useful, this ratio, to look at individual markets, but you can look at it for companies.
We're stopped that right there, guys. Just in case you were wondering, in 2000 during the dot-com bubble, the Shiller PE ratio was at 43.8, and now it's at almost 40. It's the highest it's been. That's the second highest it's ever been. And what happens when the Shiller PE ratio gets out of control? Shit, I should open up my own video. What am I doing? I'll show you guys on my own damn video.
Meet Chris and Mark.
Should be right here.
They've both heard of Bitcoin and Ethereum.
Nope, that's the wrong one. This is the S&P Case-Shiller Home Price Index, okay? And every single time that this thing goes up, we have a gigantic market correction. Every time it goes up. The last time that we saw it anywhere near this high, and this is the home price index, actually. So this is the one related directly to home prices. I apologize. I got mixed up because there's two of them that we're looking at. So that being the case, this is telling us that our real estate market is the most overinflated that it's ever been, at a index reference point of 259, almost 260. Back during the 2008 market crash for real estate, it was only at 185 when we had the massive correction in real estate prices for the better part of 2 years, in which it saw a 35% reduction almost. Okay, and just like real estate property values did as well. This is directly from the Federal Reserve economic data, okay? The Case-Shiller U.S. National Home Price Index has risen by 18.6% in 1 year. A lot of people don't understand why that is, but it's because of the low supply of homes and the high demand, especially with all the money people were getting from the stimulus. A lot of people were using that as down payments and to assist them in qualifying for a home. Now that's all turned around because an eviction moratorium has 6 million people on the precipice of eviction and 2 million on that are going bankrupt. So that's going to continue to grow. Absinthe Dixie, thank you very much. Appreciate you guys. So even rental prices, take a look at what's happened to them. Rental prices are exponentially increasing. Okay, this is straight from the White House. All right, this is my data. And that's the cost price index for rent. So that's the inflation prices of rent, you know. It's quite outrageous. And this is just from 2014 to 2021. It's not even a long chart. So basically what they're saying is their analysis suggests that these high shelter prices are likely to show up more clearly in the monthly CPI, potentially adding several more basis points to monthly inflation than they do now. They're telling us inflation is going to go higher. Do you understand? Inflation is going to go higher because the real estate bubble is going to burst. They're hinting at hyperinflation. What's up, Rodney? Totally absent. Thank you, guys. What's up, Nothing Rhymes? Check this out. Lumber prices increased 114% in 12 months. ending in, as of May. Highest 12-month growth ever. In June, iron and steel increased 73% in 12 months. But between June and July, lumber increased 20%. Why do you think the price of lumber's down? Because the demand for lumber is down. Nobody's building new homes. Nobody's improving on their homes because they're broke. Americans lost 51% of everything that they own. All of American savings was cut by 51% in one quarter, in the second quarter of 2021, guys. From 4.07 in the first quarter, 4.07 trillion, to the second quarter where Americans only have 1.97 trillion in their savings and investments accounts combined. That's 51% decrease. So what did this create? Higher than usual churn in the housing market. So people are just churning shit over. They buy things, they realize they can't afford it, they sell it. That increased the supply and the demand problem that we were having just prior to this current situation. So in the same way that you saw lumber go here and start dumping, you're going to see housing prices do the same thing. This is the year-over-year change in housing input prices for the cost of lumber and iron and steel. Because before you see corrections for the lack of new homes being built, you're going to see decreases in the prices of the items that they were using to build said homes. Rancher says, I live in a rural area. People are making our own lumber at these prices. Yeah, it's so cheap to go out and cut some wood off of a tree if you live in a rural area compared to paying these absurd prices for lumber right now. Silhouette says, if it weren't for my family, I'd be screwed. I live in Denver, Colorado, and homes are $700,000, and rent is from $1,400 to $1,600 a month minimum. I understand what you mean. I used to be a real estate broker. After 2008, in like 09 and 2010, I was doing apartment rentals because they were so much better and easier, and so much more people were looking for apartments. You know, I was renting apartments at a 20-to-1 ratio for sales. And I never sold a lot of homes, but I sure as hell rented a ton of apartments. Let me tell you that much. I got out of it a few years later and kind of got into my own real estate investments. But that just goes to show how strong the market for real estate was. And in Chicago, the average, in downtown Chicago, the average one-bedroom, 600, 700 square foot apartment is between $1,800 and $2,800 a month. Yes. And then parking is between $150 to $350 a month, depending on if you want covered or uncovered parking. Chainsaw mills. Yeah, I know it's not easy. What's up, David? What's up, everybody? Jeff, it's good to see you. Jeff asked, could the current administration have prevented the situation? Absolutely not, man. This is a situation that's been going on for so many years. It's literally been going on since prior to 1999. Bernie Madoff came up with all these schemes with mortgage-backed securities, with dark pools, and these guys are crooks. That's why shell companies, holding companies, shell companies, credit mortgage-backed securities and credit default swaps are up 3,500%, and the banks. Credit default swaps and mortgage-backed securities are up 1,600%. Oh, sorry. I mixed them up. But yeah, you get it. The banks are up 3,400. So what does that equal? 5,000% increase in mortgage-backed securities, credit default swaps, super synthetic credit collateralized debt obligations, and everything else that you can think of. Equity total return swaps. Okay? Futures swaps. And Forex swaps. I highlighted the wrong thing. Okay, equity, the fiat. That's all being traded under dark pools. And so, no, they can't. Why? I'll show you why. Look at this quarterly compression activity for notional amounts. Derivative contracts have generally declined because of trade compression efforts. So that's a good thing, but now they're on the increase. So they're basically showing us that they've been on the increase for a long, long time, since 2008 and prior. And these are the current derivatives contracts by product. As you can see, they're constantly on the increase. This is 2004. So way back in 2004, banks already had $80 trillion in liabilities. All right. The dot-com bubble only had, they were complaining in 1999 in Congress about $33 trillion in liabilities for these banks. Liabilities are expenses and unrealized losses. And then in 2008, they were complaining about, the same thing, $200 trillion in derivatives contracts. But at that time, they had much less liabilities. And now they've got $190 trillion in liabilities. Oh, I just passed it. Now they got $190 trillion in liabilities. So it's like, 6 times, 7 times what they had back in 1999 when we saw the dot-com bubble crash. These are the notional unrealized total losses, according to the Office of the Comptroller of the Currency first quarter report for 2021, available at occ.gov/publications. These key players are fucking huge on this, man. Check this out. How much you want to learn right now, guys? That's the question. How deep you want to dive? Because this isn't something that they can get just cut off. Look at 2001. Look at these numbers. They had nothing. And look at the way that it's been continuing to rise. And then market corrections will bring it down, and bring it down, and then up again on the rise and rise. Because this is the only way that they continue to boost the GDP, by increasing losses more and more. And they cannot sustain it. It's unsustainable because the Federal Reserve cannot print more money to get themselves out of it, because printing more money at a faster rate is just going to increase inflation. And alone, printing of money does not increase alone, the printing of money does not cause hyperinflation. But when you take into account a sickness like COVID-19 and the unemployment and the people that are not able or willing to work because of federally mandated vaccines and other things such as this, or because they're afraid to get sick, there's many reasons. And you also include supply and demand and supply chain issues. Your grocery store shelves are empty. Your fuel prices are really fucking high. What's going on and all these prices that you've seen that have increased more than 5.4% per month. Then that's what they're saying. These CPI numbers are bullshit. Let's move on. So we're at $190 trillion in liabilities, and here's who the fuck owns them. This fucker's right here, JP Morgan Chase, owe $53 trillion in unrealized notional losses, and they only have $3.2 trillion in assets. Goldman Sachs, 51 trillion in losses, unrealized. Citibank, 46 trillion. Bank of America, 18.5 trillion. Wells fucking Fargo, those pieces of shit, 10.7 trillion. Do these numbers look like they can cover these losses? Of course not. And look at these bilaterally netted current credit exposures. All right, who wants to fucking learn about bilateral netting? Google it, as I can't explain it this quickly, other than it's a way for them to fucking transfer money around and make it look like they're actually making money when they're not. They're just passing around bags of garbage, taking it as putting them together and counting it as revenue, even though there's a whole lot of losses that come along with it. Potential future exposure. This, just so you know, this is in millions of dollars. So that right there is, $227 billion. And these are from all contracts. So there's a lot going on, and this is just total risk-based capital. These are the derivatives losses. Blah, 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 fucking blah. Top 25 commercial banks with derivatives in this market. There's 1,389 banks in this fucking market, and 25 of them own almost all of the fucking losses. 187.9 trillion of these fucking unrealized losses, and they only have $14.7 trillion in assets. That's why the Federal Reserve on October 1st, new Phase 5 requirements for margin requirements for these banks equals they all have to have $1 trillion fucking dollars in their assets at all times. And that cannot be cryptocurrency, because cryptocurrency does not count towards a bank's asset books. That's why you see cryptocurrency pump on Friday and dump on Sunday, because they got to put it back into the market and have it on hand to maintain liquidity for the margin requirements that they have for Monday through Friday during the stock market, just to fucking keep themselves from going underwater on their over fucking leveraged positions by illegally shorting and naked shorting and creating synthetic shares on companies like AMC and GameStop and Tesla and all these other fucking companies that are out there to the tune of $189 fucking $trillion. These four banks alone owe $168.2 trillion. These four fuckers right here. That right there is 5 times the entire world GDP. I know you've heard that from me before. The CPI is a cost of living index. Its purpose is to measure the perfect price of different goods and services that households consume. Okay? We're going to hit hyperinflation here in fucking no time. And printing more money is just going to create more hyperinflation because the supply chain can't keep up. We don't have enough truckers. We don't have enough steamship lines. We don't have enough steamships. We don't have enough drayage handlers. We don't have enough container handlers, forklift drivers, office workers. Okay? We don't have enough fuel stations. We don't even have enough fuel getting around being put in places. We don't have enough gasoline and oil being produced because the majority of America's southern oil fields and oil refineries have been shut down because of Hurricane Ida. Holy shit. Are we having fun, boys and girls? Jesus. Fucking White House fucking us left and right, huh? Who wants a pretty graph? The investment components are always inconsistent with their cost of living index. Every time they make these predictions, the actualities are much different. Much different. The CPI shelter was relatively low back in the 2000s, and ever since it's just kind of continued to increase. Changes in rent, up exponentially. The inflation of rent and shelter is up significantly, and actually took a downtrend from the pre-pandemic trend because the COVID actually began a correction in our economy that the government cannot avoid. And so that is what caused things to start slowing down from the beginning. And they got out of it, and they got us this far by printing more money. And they're at the point where they printed so much that inflation and hyperinflation are upon us. Let's get on to a different thing before I bore you with the other crap here. The jobs report from the White House on September 3rd showed the economy only added 235,000 jobs, which is not good. And it's 750,000 over the last on average. But it doesn't matter. You want to know why there's so many jobs added? Because there's a lot of people that aren't fucking working, that aren't willing to get the COVID vaccine that's been mandated. The United States Postal Service, the federal entity, their union, they already told the United States government that none of their employees are mandated to get it. This is one example of many. There's also a lot of people out there that were getting stimulus money that are no longer eligible, such as 1099 contractors. They're no longer getting their stimulus money, as well as people that were getting unemployment. If they've reached their max limit on it, they're no longer receiving that as well. People on the eviction moratorium, that is out the window. 6 million people are facing rental evictions. 2 million are facing bankruptcy. And JP Morgan Chase has recently stated that they are going to be cutting, having all their real estate brokers come in to discuss the issues that are going on with Evergrande Bank and all the real estate defaults that are going on there. looking for something for you guys. Check this tweet out from Finn Watchdog, my guy. He says, got great due diligence. Look at that. Look at the SPX. That's the S&P 500 index. Longs outnumber shorts 10-1. You think that's a good thing? Not right now. Watch. Half of those positions are losing money at the 44.35 mark, 4,435 a share mark. We're currently at 44.53, and we're only 20 points away, about 0.45%. And what did we see today? Man, I'll show you guys something. Maybe I threw away those S&Ps, but I got them. S&P 500 photos. Friday, we're going to have a quad bewitching Friday as well. And we're getting these kind of newsletters that you weren't seeing before, which is always nice to see. That's what the SPY looked like earlier. Remember what he said about 445? I took this screenshot. I was tracking this all day. And I didn't know Finn was until the end of the day, actually. I figured that. I found out that he was doing the same thing. I took one after the next within moments of it, because there was a massive dump, and then it recovered it. It did somewhat recover it, but I think that was a lot of market manipulation in banks that were buying it back, because the bigger picture from it is much worse, and I'll show that to you as well. The long-term trend. This is from September 1st through September 13th. You can see the trend up at 453.63 a few days ago. We've had about five straight days, going on 6, of continuous red days on the SPY and a lot of these indexes. So you can see a recurring pattern on each of them, you know, and every time this is, you see this blank here? This is after hours. So after hours, they bought the dip from here all the way up to here and artificially pumped it, and then they sold off while other people bought in. And again, continuing downtrend. It's happening again. A pump and then a continuing downtrend. And then here we are after hours on the 13th. From the 12th to the 13th. You see it was way down here under 443, and it started the day up at 449. Ended the day at 444. I'm sorry, it didn't end the day. At this point, before noon, it was at 444, and it gained some of that back. You're going to see that continue to downtrend. You're going to see that continue to downtrend for them. Okay? So this is not a good thing, even though they make it sound like a good thing. It's not. Since monthly numbers can be volatile, it's important to focus on 3-month average rather than data in a single month. Sure. Yeah. Look, does that look good to you? No, absolutely fucking not. These are SIBO's adjustments to projections of long-run real GDP growth and how climate change is expected to change the level of real GDP in 2050. Ryan Bradshaw asked me, no, if you talked about the banks earlier, or no, you talked about the banks earlier, but if you had over 250,000 in one of those 4 big banks, as you showed earlier, would you transfer some of it to another account so your money is covered by the FDIC? I would. We are at 23 straight days of over $1 trillion on the reverse repurchase program. You see that? Is the Shiller PE ratio. It's at 38.6. Oh, does that mean it's up 0.23 today? It's up 1/4 today. It's Monday, September 13th. It was up 0.24%. That's pretty fucking good. Yeah, no, it's not. That's bad. Price to earnings ratio is based on average inflation adjusted earnings from the previous 10 years, known as the cyclically adjusted PE ratio, CAPE ratio. Also, because it was made by Robert Shiller. It was created by Robert Shiller. This guy's a Nobel Prize winner. This guy's a freaking genius. Okay? Look at where it was in 1929, right before the stock market crash. 30. I got to turn the music up a little bit. Bear with me. Hope that's not too loud. Is that all right, everybody? FDIC isn't insured. You know, they've got insurance. Don't worry, they're a federally backed company or institution. Yeah. Anyways, this is what you saw in the dot-com bubble. It was at 44. That's the only time it's ever been higher during the 2000 dot-com bubble. The only time the Shiller PE ratio has been higher. And every time this goes up to a new high, it comes down. Every single time. Black Monday in 89. And Black Tuesday in 1929. The 1999 dot-com bubble. 2008. Mortgage-backed securities crisis. 2011, debt ceiling crisis. 2013, debt ceiling crisis. 2015, 2018, 2020, and we're going to see it right here at 2021. So, yeah, good luck to all. Make sure you invest properly in things that run inverse to the market. That's what I feel. Do your own due diligence. SIBO's estimates for projections for long-run real GDP growth. Look at what the total accumulated effect of climate change is going to do to GDP growth rate. It's going to dramatically decrease the GDP growth of this country, because when Hurricane Ida and other things like that hit our country, it hurts our economy. It hurts people. It takes lives, homes. Things that need to be repaid and rebuilt. And currently, FEMA is not receiving money that Biden promised them because the U.S. Treasury cannot pay the fucking bills. This is the total accumulated effect of climate change on GDP growth relative to the benchmark climate. This is negatives, by the way. This is not a good thing. These are down 0.7 almost. This is down 1.2 percentage. Okay, and it's going to be more than this because everything that SIBO estimates is fucking wrong. Everything they estimate is understated. Everything. SIBO is the Congress Budgetary Office or some shit like that. Forgot. That's the wrong one. There they are. Congressional Budget Office. Nonpartisan analysis for U.S. Congress. And all of these assholes read this. All of the people in Congress, they inside trade using this fucking information, and they do it legally. And guess what? Come over here, look on Twitter. They've got a bunch of followers. Who reads this shit? 4 people. 4 people fucking read this shit. You know? What's the fucking point of retweeting it? Someone's going to read this and be like, oh, this is boring. Oh, this is boring, you know? And they're literally telling you everything that's wrong with our fucking country and economy, and nobody's fucking cares. The United States Daily Treasury. The United States Daily, the Treasury does not have any fucking money. They've got $208 billion left as of Friday, September 10th. This is the most recent available report. It's released about a day behind. And on a Monday, it's released on a Monday, you get Friday's report. Saladin says inflation is a myth. They can print out infinite money. It's all about supply and demand and how much people are willing to pay. You know, I have to respectfully disagree with you there because inflation is not a myth. Because when supply chain issues are occurring and you can't get things on store shelves, that creates bigger issues that stores have to increase prices to pay more to truckers and things like that to get the freight there. And it's a long supply chain issue, not just truckers, but that's just one example of many layers. Okay. So it is real, because to get that same piece of the same equipment to the store, your same food to the store, now it costs more to the trucker, to the freight broker, to the freight forwarder, to, that's the company that are moving it locally, regionally, and across oceans, right? And then the manufacturer, the distributor, and all their equipment and their water, energy, and other costs are all inflated. So it's not fake, it's real. And the artificial printing of money that's not tied to gold anymore is making our money worthless. The fiat, the US dollar, is practically worthless. Most fiats are at this point. But people still trust in it. The government is putting cryptocurrency regulations in the infrastructure bill that they're fighting about. And that's part of the problem that they're not agreeing on, because in my opinion, they're trying to federally regulate cryptocurrency so that they can create a United States dollar-based cryptocurrency based off a blockchain in the exact same way that China did back in May. China already announced it in May, and they're coming out with it very friggin' soon. It's the arms race. It's the moon race. It's the Cold War between China and the United States for the next cryptocurrency that is federally regulated, because with blockchain, it is going to actually create the gold standard again, if you will, because we already broke away from that. Holy shit, thanks for being here, everybody. Thanks for your support. If you don't mind, please drop a like for the YouTube algorithm so that it shares us with other people. Margaret Holmes has so kindly donated $4.99, 25% of it, which is going to donate charity for United States veterans this month. So thank you very much. I will post receipts on YouTube and Twitter once I do that. And I will do that every single month for the eternity and lifetime of this channel until I die. And then when I do, if this channel continues and it makes money, I will have the trust that owns this channel make sure that they also continue to donate 25% of all proceeds from ad-based revenue to charities, nonprofit organizations. Alberto, thank you for subscribing. Appreciate you guys. Saladon, no, if milk goes up $1, I'm not going to stop buying milk. Absolutely not. And I'll be okay with that. But a lot of Americans won't be. Could you imagine the price of milk going up another $1? It's already expensive enough as it is, man. I got 4 kids. I got a family to feed. The Federal Reserve has $208 billion left in their bank account. The U.S. Treasury, the United States government. The United States government spends $500 billion a month. They spent $503 billion in July. They spent $500 billion in August. And they're about to spend $500 billion in September. Sting Rocket says ribeye steaks went up at my store 130%. I know, brother. It's been really hard to find steaks on sale lately. Let's take a look at what we got here. You guys are not going to be happy. Guess who's not getting paid? HHS, Medicare, marketplace payments to hospitals, to doctors, to urgent care centers, to emergency rooms, to your physicians that accept Medicare and Medicaid, that the majority of elderly folks and children and other people that are low income that depend on, they're not getting paid anymore. As of this month, they've been paid $0. And as of today, they've been paid $0. And as of this year so far, they were paying them up to $52 billion. That's 52,000 millions, by the way. So that's $52 billion. Okay? And so far, they've paid them $0 this month. Medicare prescription drugs, they paid $7 million. They paid $7 million for Medicare prescription drugs only this month. But they've spent $97.7 billion this year so far on it. What do you think that means? Walgreens ain't getting paid. CVS ain't getting paid. Well, none of these pharmacies are going to get paid for this prescription drugs for a long time. They're going to raise the prices on retail to compensate for it. Man, spark up this blunt real quick and then I'll continue because this is some shit. Thelonious Monk, thank you very much for your support, brother. Did you see what was going on with the protests at Evergrande HQ today? Did I see what was going on with it? Dude, I fucking been tweeting it all day. I live tweeted it. Thankfully, somebody showed it to me right as it happened. I live tweeted Evergrande Bank. It's a panic. It's a panic. Chinese people and Americans and Europeans and Asians are going to feel and are going to feel this worldwide. Where the hell am I going? This sucks. Evergrande Bank defaulting on all this real estate is just one sign. Their Euro bond, their bonds that are now negative. They're trash. Nobody will accept them, and Evergrande can no longer use the RRP. Sorry, let me scroll down. That's a shitty picture. But there was literal fucking people storming the building. They were sieging this shit. It was that bad. And I'm going to show you guys. And then we'll get back to that report. Evergrande only has $300 billion in liabilities. And we just got done telling you that the top 4 world banks have $169 trillion in liabilities. What do you think is going to happen to the American stock market and economy?
World with more than $300 billion worth of liabilities.
$300 billion in liabilities.
To pay it back, sparking fears of a default that could send tremors through China's economy.
It's not just in the property business though. It also has a new energy branch, logistics branch. It has business in almost every major city and many counties in China.
Evergrande has suspended interest payments to some lenders and delayed payments to others. This week, ratings agencies Fitch and Moody's downgraded its credit status. Company shares fell by 10% on Thursday.
They're at CCC negative now. That means imminent default.
China can be said to have 2 property markets. In major cities,
CCC negative credit rating means imminent default.
Here in the CBD, the average 2-bedroom apartment costs more than $1.3 million. But in smaller Chinese cities, there's an oversupply of housing and prices are slumping. Investing too much in those areas has led to many of Evergrande's debt problems.
Tighter regulations in China's financial market.
All right, check this out. Americans have 27% of their investments in real estate on average. Chinese people have 74.9% of their household wealth in real estate property. 74.9%. Okay? This is live video of people entering and storming the Evergrande building with protest signs. This is the people cramming into the elevator, passing through the metal detectors to get into the building in Shanghai, China. Their real estate market is going to collapse, and America and European banks hold mortgage-backed securities and junk bonds in real estate in fucking China. So it's going to reduce American banks' asset books and make American banks have to cover a lot of this probably. And if not, then the Chinese government will have to bail them out and nationalize the bank, try to pull them out of debt, and possibly sell it off in the future, which they probably won't sell it off. It'll just become another communist portion of their party. It's just Nanchang under siege, you know? So this is what they're seeing over there right now. So yeah, that is going to cause turmoil. Let's see what else. Who's else not getting paid? Where's FEMA? FEMA got $150 million today, $780 million this month, and about $31 billion this year. So they are getting a little bit of money. Unemployment assistance for FEMA, the government is giving zero unemployment assistance right now. They're paying zero unemployment assistance. Check this out. FEMA, the whole, they're barely funded right now. They're going to need to increase that in order to pay for everything that they have going on right now. And look at what happened with the Economic Recovery Program. Right? The government took $74.5 billion out of the Economic Recovery Program in order to fund themselves with an extra $100 billion at the beginning of this month. That's the only reason that they still have $208 billion. So these are Janet Yellen's extraordinary measures at work. I am literally proving to you the things that Janet Yellen is doing to keep the economy afloat. And she cannot do this until October 1st because the United States government spends $500 billion on average per month. And they only bring in about $200 billion a month. So that's minus $300 billion. That's more than 100%. Excuse me. That's about, over 50% in just straight negative balances every single month, increasing. This is the Fed bank asset and liabilities. Asset and liabilities of commercial banks in the United States report H8 from the Board of the Governors of the Federal Reserve System. Sorry about that. The Federal Reserve Central Bank, and they provide this information every single Friday. It's released at 4:15 Eastern Time. There's 11 tables on here, and they're all liabilities and losses and assets for banks, commercial banks in the United States. And out of all these, you know what's increasing the fastest? The liabilities. Much faster than their residual assets. They're getting into more and more debt just to show less and less profit. They're at the point where they had $18.1 trillion in liabilities in 2020. And they increased it to almost $20.1 trillion in liabilities in September of 2021. Right, so that's a significant increase of almost $2 trillion. So they increased their liabilities by $2 trillion. That's expenses. Expenses, $2 trillion. Remember that. How much did their assets go up after their liabilities? Take their assets, you subtract their liabilities. How much did it go up? They had 1.94 trillion, and now it's only 2.08 trillion increase total. So that's an increase of about, is that only 140 billion? So in 1 year, they only increased their profit by 140 billion. But in order to do so, they increased their losses by $2 trillion. Make sure my math is right. 1,940 millions is 1.9 billion. 2,080 millions is 2.08 billion. Just confirm on that. This one here is 18. I'm sorry. I feel like an idiot. I was kind of misspeaking there. I did say trillions, but I meant to speak in billions. My apologies. That's 18.1 billion, and that's 20.1 billion. That's 1.9 billion and 2.08 billion. I'm so sorry. Anyways, that being the case, this still increased right here by 2 billion. Right here, 18 billion to 20 billion. And this only increased here by less. 1.940 to 2080. That's 140 billion. Okay. So they're not doing well. They're increasing their liabilities by 200 billion. By 2 billion. They're increasing their liabilities by 2 billion to increase this by 140. Whatever the hell I just said. Excuse me. It's getting a little late. I was thinking of the Treasury balance sheet. I've got all these. See, this is expressed in millions, thousands of millions, and this one is expressed in thousands of billions. So I apologize that I did mix those up for a little bit, and I apologize if that was confusing. We can just go straight to another one to make things a little bit easier. We'll go to the next table and kind of express it quite simply. I'll do it quickly. 18.1 billion to 20.1 billion. That's a difference of $2 billion increase. And then from 1.9 billion to 2.02 billion. So that's 20 million. 20 million. That's why I mistook it. That's 20 million. $100 million. 20 billion. Okay. 20 million. Yeah, so these numbers are fucking goofy, man. Got 1.98 billion. $1.98 billion, 113 million. So yeah, there we go. With the math in front of you, because I'm fucking drunk and a little buzzed, 1.98 billion compared to 113 million gains. So they're making almost nothing, and they're increasing their total derivatives crazy amounts with these OCC reports. Okay, these publications have $190 trillion in liabilities on them for a reason, because they're manipulating every fucking thing that you can see. This is the amount that's traded on lit exchanges. That's under 50%. Over 60% of everything is traded in dark pools so that they can manipulate the prices on it, because they have to maintain things under control. That's how we got to these terrible numbers of $190 trillion in liabilities. Plain and simple. This is the notional amounts of credit derivatives contracts by credit quality and maturity. Their quality is reducing because they're garbage. Do you see that? The notional amounts of derivative contracts by credit quality and maturity, they're constantly decreasing. All right, let's move on. If anybody's got any questions, throw them my way, because I'm about to wrap it up. Let's see what we got here. Taxes, individual income and employment taxes. They spent $1.7 billion today, and they spent $445 billion this year so far. Let's see, are they still paying the post office? Thank God. Okay, the Postal Service. They gave them $91.98 billion so far this year, and $356 million on the 10th, Friday the 10th. And again, they took $74.5 billion out of the economic recovery program in order to be able to fund themselves this far. Caesar says, are they increasing taxes for New York and California? I have no idea. Everybody's increasing taxes. Fuse, where are you in Chi-Town? I live in Carroll Stream, Schaumburg, if you don't mind. I stay in the Addison area and surrounding areas around O'Hare. Got a few business in the area. John Curtis says, Marcel, do they have to buy back all synthetics? All shares must be, all shorts must be covered. It doesn't matter if the share is fake, synthetic, real, FTD or not. It's all got to be purchased back. And when a mother of all short squeezes occurs or a margin call occurs, they have to buy back everything on that company's books to balance it out. So they're going to go through it manually and make sure. And once they see what needs to be bought back, they'll put that into the computer. The computer will do its fucking thing and automatically buy back every single short that needs to be bought back, whether it's naked or synthetic or not. Don't worry about that. It's going to all fucking come back. It's going to be chaos on the stock market, because other funds are going to be liquidating and their assets are going to be worthless. So they're going to be liquidated as well and margin called. And it's going to be an everlasting effect. And well, as we know, NSCC 010 was recently pushed back, and thankfully so. Because the pawn shop would not be good for us, because that would leave the government holding a bigger bag of shit, and that would worsen our economy. In this case, they're trying to let the hedge funds go out of business. They'll let the hedge funds fucking go under. Let the market makers in these banks go under. And maybe the government will bail them out, maybe not. I'm not sure yet. We'll fucking see. But Congress is on vacation. Shit, all the way through September. And what do we have here? That's the 2021. No wonder that was... I was wondering, like, why is that thing wrong? That's not correct. Congress isn't coming back until September 20th. Those assholes are on vacation. This one's wrong too. Stupid ass calendars. Sorry, I got one somewhere else, but just try to be quick for you and show it to you. All right, let me see here. Sorry if I got sidetracked here. Christian, thanks for subscribing. Thank you guys, everybody, for your support. Let's see. ADJ, no, sorry. These fuckers are on vacation until September 20th. When they come back on the 20th, they have to discuss the infrastructure bill. They are not going to talk about the debt ceiling until at least the 23rd. And they will not talk about the debt ceiling at all until the 24th if they don't have an agreement on the infrastructure bill. And that's not going to fucking happen. And on October 1st, as of 12 a.m., midnight that morning, the government will be officially shut down. And the government doesn't have to shut down for them to destroy the stock market. Even Democrats aren't ruling out torpedoing the infrastructure bill if some people don't budge on certain issues. This is a huge issue between the Republicans and the Democrats. Okay, they have said that they're specifically not going to agree on this $3.5 trillion reconciliation bill. They have stated it, been very vocal about it. Many Democrats and most Republicans, most every single Republican as well. So there's no way that they can have bipartisan agreement of all but three. So all but three Democrats would have to agree on this in order for them to do it without Republicans. That's not going to fucking happen because there's a lot of Democrats that are stating all over the place that dozens of Democrats, a senior Democratic aide told Fox News that dozens of Democrats would vote against the infrastructure if it was voted on without the reconciliation bill. So they're just going to butt heads like they always do, like they did in 2013. They knew what they were doing then, and that's why the Fed president is selling off all his blue chip stocks. That's why Congress is selling off all their blue chip stocks. Don't believe me? Google it. Employment growth slowdowns came from leisure and hospitality, government and retail trade being highly below average. What does that mean? Hotels, stores, retail stores, government entities, wholesale trade, warehousing, distribution is down, things like that. So it's across the board. And other services that are hurting our economy. And the ones that are positive are nothing above average. With no change almost over the 3-month growth. So they had no growth and tons of losses over 3 months. Okay? Another example of the impact of COVID on the labor market is that as COVID cases rose due to Delta, individuals are more likely to say their work decisions were being impacted by COVID. Fuck. Saying work decisions were impacted by COVID. I need a beer on that note. Shit. That's crazy. Excuse me. I'll be right back. All right. So, thanks for being patient with me. Damn, it's infuriating, huh? The sickness that these guys are working on. Cheers, everybody. Drink them, smoke them if you got them. But yeah, let's switch it back over. Yes, Aladon, a lot of people did die from the flu and the swine flu and every other flu every 4 years before that. You're absolutely right. Absolutely right. A lot of people did. Also, Rothschild had a patent on the COVID virus since 2015. Google it. Cheers, everybody. Here's individuals saying work decisions were impacted by COVID-19. Increase in August. Looks like quite a few people in December, and it has not changed much in August because a lot of people already made the decisions. Employment rate ticked up 0.1% overall and 0.2% points for workers aged 25 to 54. That's nothing. 0.1% increase in employment? Guys, they're telling us that unemployment is getting better, but it's not. The White House is telling us clear as fucking day that the employment rate ticked up by 0.1%. The employment rate is at 58.5%. That's miserable. So what does that tell you guys? What's the strength of our economy right now, truly, and our stock market? So that's where we'll leave that. What do you think is going to happen to the stock market when these guys? When these guys go and have their debt ceiling issue? Same thing that always happens. Same thing that always happens. United States credit rating gets downgraded. Agencies reevaluated the U.S. government and moved them from an A to an A minus, maintaining a negative outlook on our country. That destroyed our stock market. $2.5 trillion were destroyed from the stock market and global equities in one day. And it wasn't just one day. This lasted from September 19th to October 9th in 2013. September 19th to October 9th. Sorry, October 17th. My apologies. It went even longer than I thought. So, great. It destroyed our fucking economy back then. And we only had a $16.3 trillion debt ceiling. We're currently at $28 trillion, which has now been reduced back to the previous level of $22 trillion. So we're way above that at the moment. That's why the U.S. Treasury can't get any more money or doesn't have any more money. They will receive minor income in tax revenue. They will receive minor income in tax revenue. Not a big deal. It's not going to be enough to get them through until everything's finally passed. And I think because of that, we're going to default on America's debt to other countries for the first time in history, and that is unconstitutional. That is unconstitutional for the United States to default on its debt. So it's quite a scary time. And it doesn't have to default on its debt for the stock market to crash. And when it crashes, banks and market makers will lose liquidity. And when they lose liquidity because their assets are tanking, certain meme stocks will go through the fucking moon. Literally to share prices that nobody can fucking imagine. Maybe $50,000, maybe $500,000 a share. We've seen it before on other stocks. And this time it's worse than ever because they've been shorted since before 2008 for GameStop and since soon after 2008, 2010 for AMC, in my opinion, as well. So there's that. Cheers. Cheers, brother. Thank you, guys. Appreciate your support. Revel Works, thank you very much for your donation, your support, buddy. I'm more than happy to give 25% of this to charity. And thank you for listening. Please share this, everybody. If you don't mind, please drop a like, maybe a comment for the algorithm, not for my ego. I don't really care. I do like interacting with you, though. Alex, thanks for subscribing, brother. Jonathan Wellinger, thank you so much for your support and for super chatting, brother. Appreciate you. Cheers, Wolfric Doomslayer. Appreciate you, brother. All of you, brothers and sisters. Thank you. So this is what my theory is, and sad to say, I don't think it's a theory. I know that these guys know exactly what the fuck they're doing because it's the same people in party. Sorry, hold on. Mitch McConnell, as well as other Republicans, you know, John Boehner and all these cats, argued that the debt ceiling should not be raised unless spending is cut by an equal amount to or greater than the debt ceiling increase. Does that sound familiar? Like we just did not read that? We did just not read that exact same thing over here? We still have a couple of weeks to get this worked out, Bowman said. It's important for the American people to know that this is Democratic agenda in terms of Democratic leadership. Biden's on board, Pelosi's on board, Schumer's on board. So some of them are on this fence, some of them are on the other, and the Republicans are nowhere near them. You know, they're accusing each other of holding one bill hostage over the other. They're arguing that bipartisan infrastructure bill is the legislation that is actually urgent, and it's not going to fucking happen. Because they're fucking arguing it with the same way that they did in 2013. Except this time it's worse. Because back then it was just the debt ceiling. And that, you know, not raising the debt ceiling would cause payments, including benefits, government employees, salaries, lead to default on the government debt, blah, blah, blah. And yeah, it's never happened in history. But if you think it can't happen, you're a fucking fool. It can happen at any fucking moment. Especially when things like this are happening. And I'm thinking it will. I've put my money on it. So yeah, that's my rant. That's my thesis. And I hate to say it, but I'll be shocked if I'm wrong. I'll be fucking shocked if I'm wrong, because it's going to destroy 99% of middle class. It really is. It really fucking is. Let's get this shit out of here. Screw these Republicans, these Democrats, all these fucking shills. And Gasparino and Rich Greenfield, fucking Kenny G. Fuck you, Kenny G. I'm going to get my money from you, Ken Griffin and Citadel. And Gary Gensler, SEC, I'm coming for my whistleblower money. You know you're going to be talking to me. Joe Rogan, hit me up, brother. I know you got my emails, as well as your team over there. We got to talk about this. This is going to be fun. Jesus. But yeah, let's take a look at the S&P, 500 PE ratio. The only time it was higher than now was in 2008 and 2001 for the S&P 500 PE ratio in all of history. So it's at the third highest technically, because it just corrected slightly in 2020 and we printed our way back up to that level. So it's at the second highest level, third highest level it's ever been in history for the S&P 500. It's at the second highest level for the Shiller PE ratio, period, for the stock market. It's at 38.6. The only time it was bigger was during the dot-com bubble. We're extremely overinflated. The 10-year Treasury rate is at 1.33%. And the government estimated that it was going to be currently in the 4.5% to 6% range. They were fucking wrong, obviously, because it's at 1.33. And the 3-month Treasury yield is at 0.04 as of September 10th, 2021. 0.04. It's about to go negative. Just like the Euro bond did. Euro bond has gone negative for the first time in history. Let's see what we got here. Oh, that's old. B of A Euro High Yield Index effective yield. This is European junk bonds. They're at 2.32%. That is lower than inflation rates. Euro junk bond yields are below inflation for the first time. So they're actually making a negative return for the owners of these bonds right now already. And it's a 2.3% yield on the ICE B of A. Just showed you on the Federal Reserve Economic Research website, fred.stlouisfed.org. This is trash, and pretty soon they're going to dump even worse. Three-month Treasury yield. They estimated it to be, I forgot, but they expected it to be somewhere between 1.5% to 3% for a 3-month Treasury yield, if I remember correctly. And the numbers it's at is just ridiculous. Look at what we saw back in 2020. See what that says? Negative yield. Not accounting for inflation. You still got to add inflation onto that, so it's even more negative than negative 0.04 for a 3-month bond. That's why they're not using it. That's why they're using the RRP. RRP, Reverse Repurchase Program. Treasury securities sold by the Federal Reserve for 1 day to a bank, and the next day sold back. What are they doing? They're trying to flush cash out of the system because they've got too much money in the system. This is how the Federal Reserve burns cash. This is how banks maintain liquidity. But they have too much liquidity, and they have to maintain it, and they actually need more. They have so much, they keep it in this to prevent from losing it to the 3-month negative yield. The negative when you account for inflation for the United States Treasury bonds, just like the Euro junk bonds are at 2.3%. And when you account for inflation, that's negative. And that's for the first time in history. Okay? So there's no returns on these things. So they have to keep their fucking money in here. And in return, the Federal Reserve allows them to do it, burns up some of the cash when they receive it, and, gives it back to them with interest, 0.05, which is not even enough to account for inflation. But it's better than having to leave it in there for 3 months, and then when the stock market collapses, they'll lose it all, and then they'll get margin called. But they're going to get margin called anyway. That's why the Federal Reserve increased their margin requirements to $1 trillion starting October 1st, 2021. So I'll leave you with that. Just take a look at what happened with the RRP. Every time, prior to every single stock market correction, just prior to the crash of 2020. See, back in March, it was at almost nothing. And then by March 31st, it was $284 billion. Because they needed to stash the money somewhere to try to hang on to it. I mean, they didn't. They weren't able to. Same thing earlier this year, big increases, and then just constant exponential increase since. We have 23 straight days over $1 trillion in the reverse repurchase program. They used it back in 2008. This will be the last thing I'm going to say. They used it back in 2008, and you see how much they used it? They didn't use it at all. And then when they really needed it during the 2008 crisis, September 24th through October and November, $25 billion. So the mortgage-backed securities and derivatives issues was bad back then, and their liquidity requirements and margin requirements were bad back then. But they still only needed to use the RRP program for $25 billion then, and they used it slightly after 2013. During 2013, during the debt ceiling issue, it went from 0 up to $102 billion. That's during and after the 2013 debt ceiling crisis when the market tanked. And again in 2018, they pumped it up when they needed it, and in 2020, and we're at record level highs because they're going to go fucking bankrupt and they know it, so they need every penny that they have on hand. That's it, everybody. That's all I got for you. I think that was a nice long DD session. I hope you enjoy it. Hope it's not too long for a lot of people. I might have to cut it down to smaller segments. But I think with macroeconomics and things like this, you really have to look at the big picture. So Cheers to everybody. I wish you the best of luck, peace and wealth, and the best of luck in your investments and health as well. God bless. That's the end of the central banking system, my man. I don't know. I'm not sure if that's going to happen, but there's some tough time ahead. Tough times ahead. So, thank you, everybody. I appreciate you. Peace out. Much love, fam. Thank you for your support, everybody. Jonathan, thank you very much for your support. Appreciate your donation to the channel. 25% of all donations will go to charity this month to United States Veterans nonprofit organization. I could take like 2 or 3 more questions if anybody wants to. If you just feel like throwing me a question, I'll answer it for you while I wind down to this last song and this last beer. Do me a favor, drop a like if you can. I would appreciate that. Thank you very much. And moon soon, bro. Moon soon, as they like to say. That's my opinion. Not financial advice. I'm not a financial advisor. Thank you again, Gen Z, starring Eli, Glizzy, Jenny, all of you guys who have helped moderate, and Jackson Hunter, AMC Bigums, Houston Wade, Jamie from Trade Spotting, a lot of other good quality people out there that you should watch and do your due diligence. And a lot of people in the Twitter and Reddit community as well. Thank you for your support. A lot of people on LinkedIn. Thank you as well. It's great seeing you. Hit me up on LinkedIn as well because I like to share it on there because there's a whole nother platform of people. There's a whole nother platform of people on LinkedIn that are not on Twitter or that are not on, Reddit, for example. So, or don't watch YouTube much. So there's a lot of people that we could reach in different avenues, I feel. Real rugged DIY, buy the VIX? I don't know, man. I like the idea of taking calls out on the VIX, for sure. Because the volatility index is going to fly, in my opinion. Yeah, Rancher, we've done a few due diligence sessions. We did Apes of the Round Table with Jackson Hunter, Trade Spotting, and Houston Wade and myself. And then just yesterday I did another like 2-hour long one with Kringle Kitten, AMC Bigums, and Wired, and Jackson Hunter, as well as I've done other YouTubes with Dave's Daily Trades as well, kind of explaining the whole theories and such. So feel free to check them out if you'd like. Shit, when is the moon? In my opinion, the moon is going to come shortly after we're going to have this debt ceiling crisis. Right around when the time they come back, after September 20th, they're going to fight and they're going to argue, and people are going to realize, oh shit, this is not going to work out. The stock market's going to tank. Let me take my money out. They're going to see it tanking. A lot of people are going to do that. It's going to hurt retail. It's going to hurt. There's going to be a lot of bag holders left in retail. There's going to be a lot of people hurting, in my opinion, that are whales and that are institutional investors, so they're going to sell out as well, and it will cause the beginning of the mother of all short squeezes. It will take time, in my opinion, for it to happen, so it might take a few days or a few weeks after that, but once it gets going, you're going to see volatility and crazy high numbers, in my opinion, like have never been seen before on the stock market. So Potato Assassin, yeah, I'll do call-in questions. I just started a Discord recently. Maybe for the next video, I'll just do like, hey, whoever wants to jump in the Discord and ask questions, or we'll do a Twitter space call, and we could do, you know, a Twitter space call, and I'll just host it right here. I'll put the audio through my computer or through my phone, because Discord is kind of weird on the Discord works well on the computer. We can do that, but Twitter does not. Twitter space call has got to be on your phone, but I could definitely display the audio up here and take questions from you guys, because I'd like to hear your input. I would much rather have it interact with everybody. Yeah. Sean Marco says, I really enjoy your talk with the other guys who know a lot of macroeconomics like last time. We should do more like that in the future. Yeah, Sean, we definitely will try. We're going to try to do that every Sunday if possible. Every Sunday evening, we're going to try to do something similar to like that on one or all of our channels. So I'll catch you guys hopefully Sunday night, and we'll do the same thing. You guys probably catch you right here on my channel. We'll have, you know, whoever can join. Maybe I think we'll have different special guests every Sunday. Bookman asks, are you going to sell on the way up? I have my bracket set up where I can't sell until it hits 10K. I like that idea. Yeah, you got to sell on the way up, but I'm not going to start selling until it gets really high. You know, you got to have your number involved. And when I start selling, I'm not going to sell it all. I'm only going to sell a small percentage at once and make sure it continues to go up, and then sell another tiny percentage, make sure it continues to go up, sell another very tiny percentage, and so on until I feel it reaches the top. You'll never time the top perfectly, so just do your best. That's my opinion. That's what I'm going to do. Yeah, I will continue. And then once I think it's coming down, I'll continue to sell a little bit at a time here, wait for it to come down a little more, sell a little more. And if I don't think all the shorts have covered, I'll maintain some of my position. And then I'll wait for another squeeze. So that's my guess. Peace out, everybody. Have a great night.